So you sold your home and you're thinking, I made some good cash, it's time to go splurge. Well, no. The IRS knows you sold and they may come knocking. So today I'm coming to you with all things capital gains to help you understand them, how they work, when they work, and how you can avoid paying them all together. Welcome, my name is Ama. I am a residential real estate advisor here at Lux Residential Group, brokered by eXp Realty, and I'm serving the beautiful state of Georgia. Full disclosure and disclaimer, I am a residential real estate advisor, not a CPA, not a tax advisor, not a financial advisor. But oftentimes at the closing table, especially when my clients are getting a fat check, they ask, will I be taxed on this and how much? Well, I've got you covered today because I'll be sharing all things capital gains. So let's get into it. What are capital gains? According to the IRS, a capital asset is anything and everything you own and use for either business or investment purpose. Now, a capital gain is the net proceeds that you make from selling such capital assets. Now, what will your capital gain be taxed on? It will be taxed on three things: the duration you own the asset for, your tax filing status, and your cost basis. When will you be taxed, you asked? You will be taxed on the sale of such capital assets if you have not owned the property for up to 2 years, it wasn't your primary residence, you've owned it but not up to 2 years, or you've owned it for longer but you haven't lived there as your primary residence for 2 years. Keep in mind, these 2 years do not have to be consecutive. You also may be taxed on it if you are subject to, say, expatriate rate. You will be charged based on that. And if you have bought this property as a 1031 exchange, you're also going to be taxed. The rule typically says you have to live in that residence, own it for up to 2 years of the 5 years before the sale. Of course, keep in mind that exemptions do exist. Speak with your CPA, your financial advisor, or whoever you go to for tax advice. How will you be taxed? You will be taxed based on duration, remember, cost basis, and your tax filing status. The IRS typically classifies duration based on two things: the short term or the long term. Short term is basically any asset you've owned for less than a year. A long term is any asset you've owned more than a year. If you own the asset on a short-term basis, which is less than a year, the IRS is going to tax you based on your income filing bracket. So you want to review what your tax filing bracket is and calculate your potential capital gain taxes based on that rate. For a long term, you have good news. There are only 3 brackets you can get taxed on, 3 rates basically. There is 0%, 15%, and 20%. Let me give you those numbers. If you are single filing jointly, you may be qualified for the 0% tax if you earn less than $41,700. If you're married, it's double that. And if you are the head of house, it's usually $55,800. You are exposed to the 15% tax if you earn from that $41,700 up to $449,752. If you are married, it's $517,000. And if you are the head of house, it's $480,500. Anything exceeding that is the 20%. And I've heard that there are exceptions where you may be charged more than 20%. But there is also good news. If you've owned the home for more than 2 years, you live there as your primary residence, you do qualify for what is called a capital gains exemption, meaning you do not have to pay on the proceeds. Good news, I know. But of course, there is also a caveat. The IRS is smarter than that. If you've lived in the house and you qualify for the exemption, meaning you've stayed there for 2 of the previous 5 years before the sale, if you are single, you can exempt up to $250,000 on the home sale. If you're married, you can exempt up to $500,000. That's great news. But what if after exempting those amounts, you still have cash left that is subject to the capital gain taxes? Let me give you a pro tip here. You can increase your cost basis legally. As a homeowner, it is very typical to make improvements. If you splurge $20,000 on a new kitchen, tile, hardwood floor, a fence, your landscape, whatever expense basically that you made in that home, keep a record of it. Keep receipts and invoices. Basically have all the paperwork. Because when it comes tax period and you're subject to capital gain taxes, you can provide those receipts to your CPA or tax filing person to help you offset some of those liabilities. Remember, any expense or improvement you make to the house adds to the cost basis. So if you bought the house for $200,000 and you spent a good $200,000 on it, you just increase your cost basis from $200,000 to $400,000. So keep this in mind, homeowner. Keep all the receipts. I hope I've been able to shed more light on all things capital gain. Again, I am a real estate advisor, not a tax advisor. So if there's any tips that you need, any advice, please reach out to your CPA, tax advisor, financial person to give you a more tailored example of what actually fits your needs. If you found this video useful, I invite you to give me a thumbs up, hit the subscribe button. The notification bell will be nice so you know when I upload new videos, which will be weekly. But to my next video, ciao!